Uh, Let me start with that now. One of the highlights from Alice's reports is a question around the write-off of bad debt, the implication it had on corporate income tax. And of course, the question we are asking is from financial reporting standards treatment. Where do we stand as a country, as a jurisdiction? We have seen guidelines from the Central Bank of Kenya. And what policy reforms would guide us forward in view of what this has reflected in terms of impact?
Thank you, Julians, and good morning to everyone. So, Julians, let's start with the basics. Banks generate their income by extending credit to their customers. So the moment a loan goes bad, it means that they have actually lost part of their operating capital. So any delay from a tax point of view in either allowing or denial of the deduction of this bad debt as an expense means that these banks are actually paying higher taxes but on shrinking incomes. So this is going to constrain liquidity for the banks and their ability to also continue extending the credit facility. A sound tax policy should ensure that this deduction of this expense, at bad debt expense, occurs the same year that it is actually incurred. And you've talked about the three frameworks that we actually have as a country. So you're right. Banks have to stick to the regulators' prudential guidelines, that's CBK guidelines. They also have to stick to the KRA's guidelines that were issued in 2011. And they also have to look at the accounting standard. So in 2018, we started implementing the International Financial Reporting Standard 9. Unfortunately, Julian, these are not fully aligned. So it is administratively cumbersome for the banks to actually look at these three standards and make sure that they comply. What have we seen other jurisdictions do? So countries such as South Africa, upon implementation of IFRS 9 in 2018, incorporated this in their tax law to align the treatment of bad debts with the accounting treatment, the tax treatment with the accounting treatment. And South Africa has not done this in isolation. We've also seen outside of the continent, countries such as the United Kingdom, we've seen Australia, Singapore, and many other countries trying to align the accounting treatment with the tax treatment. And the rationale is simple. As I said, you don't want banks or financial institutions to be paying tax on an expense. Yeah, they have already suffered an economic loss. So you actually want to sympathize with them and allow that as a deduction. So the opportunity that I see for us as a country is to actually allow financial institutions to align their tax treatment with IFRS 9. IFRS 9 has very strong safeguards to make sure that any loss that is being recognized is not being recognized prematurely. And I think this is going to strengthen the credit market and simplify compliance. Julian.
So the take home there is that we need alignment when it comes to IFRS 9, the guidelines we receive from CBK from a prudential perspective, as well as the tax treatment guidelines we see from the Revenue Authority. Peter, another reason why corporate income tax from banks has a contraction here is the fact that from an asset allocation standpoint, 2024 was a bit of a peculiar year. We saw yields rising significantly, especially on infrastructure bonds and etc. So from an asset mix perspective, what pathways do you see going forward to ensure that banks continue delivering on their social contract of lending to you and I?
Thank you very much, Julians, and good morning, everyone. Yes, indeed, you're right. That observation is correct. But I think first and foremost, it's good to say that banks participate in the bond and government security market, just like any other investor, right? And obviously, we pride ourselves in funding national budget and government projects, and there can't be any other better way to do it than when, as you've said, the rates are looking good and there are some incentives. But I think it's important to indicate that we never do this at the expense of capital and funding that is available to our customers. So we always have enough liquidity and capital to lend. But the problem is not really how much government is borrowing or how much of assets we put in government security. The problem is much deeper than that. And I think that's what the CEO really made a clarion call on. So I think the first, the rates are coming down, and that's good. That will hopefully enable us to lend more. And we welcome all the changes and the developments that are happening in the rate space, including the move to Kesonia. So low rates are good for the banking industry. The reason that you saw that change really is because the rates were good. We had a sort of a bell shape kind of interest rates from 2022 to 2025, peaking in 2023 and 2024. And obviously banks are also, investors. We owe a duty to shareholders to return the best return for their capital that we can. So if we get opportunities to participate in the bond market, we do. But really to emphasize, that never leaves us without sufficient capital to lend to customers. What affects lending to customers? First is really their disposable incomes, ability to borrow, demand, and we would love a situation where we have as many people who can qualify for our facilities as we are willing to offer, and obviously the demand and ability to borrow is significantly and fundamentally undermined by disposable income, and that conversation has been had here. So I think, Julian, in essence, what we are saying, we are well capitalized to lend to anyone out there, any of our customers that is looking for a facility. Thank you.
Thank you for that, Peter. And in case you were lost when it was talking about Kesonia, that is the renaming of the interbank rates. Remember, effective December 1st, there is a transition to the new risk-based credit pricing regime in this country. Jojo Bell, Commissioner, how are you? When I start like that, you know it's a hard one coming. George, complexity has been highlighted as a key challenge, and not just for bankers, for everyone in this economy who is willingly seeking to comply with taxation. Where do we stand and what is KRA doing? The second leg to that question will be to Edna.
Again, thank you, Julian. Julian normally always ready to give us very hard questions and we appreciate that. And thank you for inviting us. I think let me start by saying first that we've got a very good relationship with the financial institutions, and KBA highlighting that. I think the key thing that which I need to mention, is that one of the key things that shows you that you work very closely with the banking institutions is that we've got an SLA. So if there's one of the people that give banks some money to lend out, it has, because we've got an arrangement of T+2. When you get all that taxes and you've got to keep it for 2 days, that's a very good place, because that's a very good symbiotic relationship that we have with the banks here. But getting into this discussion about the cost, one of the key things that really for KRA is a very important thing is the cost of compliance, how we can bring that down. It's a very critical component that we look at to make sure that we bring that down. And today we have got technology. The technology that is available in the market can be able to easily take us to that way, as opposed to where we were before. And that's why you can see we've got all this digital transformation agenda that we have that is beginning to take us to the place we want to get into. And you can appreciate, for example, when you've come up with this e-invoice solution, what you are calling e-teams. You can see now for VAT, for example, now we can pre-populate the return. Earlier, people were employing people to do that work, but today we can pre-populate for you, and then we just need to click a button. And that's the direction we're going also for income taxes. Because if you can be able to see is that now there's a requirement that all the expenses that can be allowed, other than the ones that have been put separately by the law, they ought to be supported by e-team invoices. So you can see the route we are taking is to make sure that we can pre-populate the returns. And the other thing that we are doing, which you've seen the way we are structured ourselves right now, again, is to address a bigger issue that was mentioned here, that there's a narrow base that is carrying the weight of tax, is to broaden that base. And this time around, we have taken a very calculated, big move, is to structure ourselves to be able to focus on the other sectors that may not be contributing to the basket. And these sectors are these smaller, what sometimes we call them that they are not very structured, very organized. But if you look keenly, you begin to see that there's some formalization in those sectors. Yeah. For example, they're operating a lot more in the mobile platform. So that gives an opportunity. So to a larger extent, they are formalized. So there's an opportunity there that we are seeing to be able to leverage. Now, the fact is this, is the more we bring, the more we make sure our systems are responsive and are easy to interact with, then the costs start becoming lower. And that's the intention that we plan to get into that level. So you see the investment that we are putting on the technology and everything else, you suddenly see it taking to another level, much higher level. Support taxpayers, make it easier to do that. There are certain things that we are doing also to support also the smaller ones, like what the banks have done, which we really appreciate. You see, to reach out to the unbanked, they have gone through the agency model, and you are saying, why not? Even KRA can reach out to the agency model. You see, so we go into that model also so that we can be able to have some intermediaries who are even helping to educate taxpayers and make it easier so that they can be able to pay their taxes more easily. So there are several solutions that we're putting. One of the things we have discovered is that if you look at the WhatsApp solution, for example, today, it has got less friction. So it's easy to comply with. And we're saying, why don't we now ride on those kind of solutions that are already available in the market? And we begin to start having solutions that are available in those products. So it is a journey that we are taking. We want to move as fast as we can be able to. We are not yet there, but there is a headroom that is taking us there. And that's our commitment to make sure that we close that gap. Thank you.
So, Commissioner, on the point of the population of PAYE, so June 30th will cease being a day of trepidation for taxpayers.
For sure. That's our focus, to make sure that we make it easy. Now, for example, those people who they have deducted PAYE. Are you saying, why don't we have the information? We have the data. We can repopulate. We can make it easy. Why don't we wait for June? We can be able to do it for January, February. So this new year that you're seeing, most of those people will have fallen off because we'll not wait for March for them to come in June. Yeah. We'll have resolved their issues much earlier before that time, so that you can leave those people who are doing other mathematics. From our side, just to let you know, the money has already come. I mean, we shouldn't be having this. We should make it easier, you see, and that's why we are enabling our system to make it easier, so that we can spend more time on those ones who need them to pay, because we have got information about them. So there will be some other products we'll be able to see us doing. One of the sectors, for example, that we need to focus on is the personal income tax. That has got the largest tax gap. Yeah. So we are looking at how to get into that space. Yeah? And in this day and age, there's a lot of data that is available that can be able to tell us what is the capability of that person to pay tax. The means test, for example, should be easy for us to do that with the data available. It means, therefore, we can go into that space and begin to broaden the base.
Let me hold you there, because Jojo Bell can go on. Edna, the second point to that question is, from a compliance and easing the burden that is on taxpayers and bankers in this case, what do you see as global best practice? What options lie ahead?
Yeah, thanks, Julian, for that. When that number of 13.5 million was presented, I thought this is actually a significant number, and this is just a representative of the population. So if you think about other taxpayers, then the cost of compliance is really high. And when you have a high cost of compliance, then you actually bring down voluntary compliance. So, and this tax, the cost of compliance is actually like an operational cost that is eaten into the profitability of businesses. So it acts like an invisible tax. So I see two pressure points that the government should consider working on to bring down the cost of compliance so that we can have more voluntary compliance and plug that gap that Obel was talking about, the income tax gap. The first one was already alluded to by both you and Alice about the frequency of filing. So this requirement that you have to pay withholding VAT and withholding tax every 5 working days after you make payments means that there will be more administrative tasks that these taxpayers are going to carry out. And these administrative tasks actually cost drivers. the workaround that many taxpayers have come up with is to lump their payments and only make payments in specific days of the month. What does this do to the economy? It actually distorts the cash flow that is flowing into the economy. And I think the simple solution there is allow taxpayers to pay their taxes once a month, the withholding VAT and the withholding tax. I get the argument. I also got the same response from Parliament that this is not your money, but it's an administrative task that taxpayers have to get into. So just allow them that ability to do it once a month, except if they are risky categories of taxpayers. The other pain point, and I want to throw some friendly fires to my friend Obel.
She has even turned.
The other pain point, Obel, is around eTIMS and the fact that we have linked the adoption of eTIMS with deductibility of expenses. This is actually driving the cost of doing business, because if I am trading with Peter here and Peter is not on eTIMS, it means that automatically I have an additional 30% cost on the cost that Peter is already charging me. And this is eating into my profitability. So in a few years, because I want to preserve my bottom line, I might consider and say, I don't want to do business with Peter. And unfortunately, Peter would be representing the micro, small, and medium enterprises. Perhaps I want to do business with somebody else. So what this does to you as a revenue authority is that you do not get this visibility. Because now Peter, being in the informal sector, is going to trade with, say, Julian's also, who is in the informal sector. So you miss out on this. My proposal is actually allow taxpayers that deduction, but maybe there should be some special reporting of those transactions. Perhaps if I upload my digital proof of payment or my contract, it's going to give you visibility of the transaction that has happened between Peter and I. And it's going to complement the reverse VAT invoicing from a VAT perspective. And I also want to say this one thing, Obel, with a lot of faith, good faith, it's around adoption of technology. Technology is very good, and we like technology. It makes our life easy. But more often than not, it feels like the Revenue Authority only just considers the upfront costs of adoption of technology. There is an upfront cost both from taxpayers' perspective and also from the Revenue Authority. But you forget to factor in the culture change. This culture shift, you must invest in culture shift. And one of the ways that tax policy can actually support this culture shift is not by penalizing taxpayers because they are trading with non-compliant taxpayers, but actually encouraging them to continue trading. So one of the ways is delinking the eTIMS compliance with the expense deductibility rules.
Before I come to Peter, it's only fair that I come to Commissioner Obel, because what Edna is saying is we need a rethink of Section 16(1)(c) of the Income Tax Act on the deductibility pegged on eTIMS to the degree that it relates to Section 23 of the tax procedures on eTIMS. The mic even went off.
so let me start first of all with that the withholding tax 5 days. I think we need to do something about that. I think we need to have a conversation of how to make that easier, especially from our side, because you're making a payment. When you're making a payment, we are talking about 5 days. I think earlier it was 1 month. We have gone to 5 days. We need actually to transition to the transaction itself. If we can be able to make it easier so that by the time you're making that payment, because when you're making that payment, you're not paying more. You're actually just paying whoever you needed to pay. But then you're paying less the tax that you need to, the withholding tax you need to do it. We should be able to get into that level. And technology right now should be able to take us into that level. So on our side, there's certain things we need to do to make it easier. I think the problem is, for example, right now, you've got to raise a PRN to make sure that payment is done. We are now focused on that so that we make it easy. So that you can see the transaction, for example, for M-Pesa. Are you seeing it? The split payment just happens. That's the place we are supposed to go to. You see? And so we are looking at that model. How do we make sure we get into that level so that the payment, are you seeing, when you make the transaction, the monies are split and it's gone and it's easy. So there is no complaint about it. The complaint here then is that when the payment is being made, are you seeing, for you now to make sure the split payment happens, you've got to do some other procedures, the KRA side procedures, which we need to cure. And that's a focus that we are now doing to make sure that we really make it easier. You do not have to raise a PRN. It should come automatically so that you don't have to do anything. You just need to identify the taxpayer by the PIN and then the payment can go through. So that's the journey we are taking. But I'll go into this issue of eTIMS and then we make just a comment about it. I think the proposal which you're putting are good, first of all. The key thing here is that by the time we came up with this and it was put into law, is to make sure that we broaden the base. Because that's the bigger conversation, first of all. The bigger conversation is that the burden is on the back of very few people, either large players and the payroll people. Those are the people who are carrying in the burden. And so we have got to then expand this and make sure we bring all these other players in. So the route we have taken is to make sure that if you're not playing by the rules within the market, then you are squeezed out. And that's the route that we took first. And it's good to listen to the advice that is being given so that you can see how we can tweak that and make it better and easier. I agree on the change management. That is important. We have got to do that so that you can be able to get into that space. But these people who are not paying tax make it difficult for the others. And that's why you see when we start going into the rates of 32.5% and 35%, what we talked about earlier is a result of some of these things, which needs to be addressed. If these are addressed, we could even be able to see the rates now coming lower, because then the contribution to GDP can still be maintained at a higher rate, 18, 20%, but then the rates are lower. So that we can be able to get into that space. So, and if you look also at what we have done now, we have not been very strict onto that. If you look at last year, we were not strict on that, because we are allowing this to mature so that we get into that space here. But definitely the more players, when we get into the critical mass, into that space, then we can be able to tweak several things to make it easier and better for everyone.
Peter, please make your comments, and then I will invite each one of you to make your closing because we need to get to the keynotes.
Thank you very much. You know, when George Bell says that the many people not paying taxes are making it difficult for the few who are paying.
So you're being punished.
That's really resonated very much, with the industry, because we are the few who are being punished. But I thought I'd make a comment on this debate on cost of compliance. And I think the numbers and the cost must be much higher than actually, what we saw in the survey. And the reason I say this is, in a survey, the numbers that people give out is the numbers that is on their face, the number that is easy to sort of pick and come up with. But if you were to do the entire value chain total cost, it's much more significant. Yeah. And the question is, what can we and should we do about it? And I think when we was, studying tax back in the days, we used to be told the hallmarks of a good tax regime is convenience, simplicity, and less cost. I think the writers and scholars of tax must today change that and tell us that the hallmarks of a good tax regime is digitization and automation. And that must be at the forefront. And we, of course, congratulate KRA on the efforts made, but I think it's not enough. There is much more that should be done to bring that cost of compliance much lower. I think the other thing that actually must be done is we have so many changes in tax laws. The last 2 years, we've not witnessed that for exceptional reasons. Yeah, but the many changes in tax laws have a significant effect in increasing cost of compliance, because some unfortunately bring uncertainty and confusion. They make us pack a lot of disputes and cases in cost. The other day, someone was suggesting that in 5 years, or pegged to a government regime or tenure, the government should be allowed to change tax twice. Yeah, have 2 finance acts only, at the midterm and at the end. Yeah, and I thought that was, quite a good suggestion, because in any case, the national tax policy actually suggests the same. So many tax changes are actually increasing the cost of compliance. A lot of disputes are increasing the cost of compliance. I think in the judiciary, someone was saying in the commercial and tax division, we've probably packed about $1 trillion worth of cases there. Tax is probably something like, 30% or whatever number. So that is something that also we definitely need to look at in terms of how to solve disputes. And I think I would like to conclude by saying, when we have good borrowers, who have a good credit history, they are not in CRB. Today, with the new revised risk-based pricing model, they will enjoy a good, rate premium. Their risk is low, they get a good rate. So with the numbers that we have seen today, so banks should also enjoy a good rate in terms of the visits and the inspections, by Revenue Authority, because that's also a cost of compliance. Thank you.
Thank you, Peter. In the interest of time, because we have transitioned to the chairman's remarks, let me invite each of my panelists to give their closing thoughts. And the closing thoughts are basically your key takeouts and what are your core proposals as we move forward. Let me start with Edna.
Yeah, thanks, Julian. So when Raymond was giving his opening remarks, I was very tempted to clap to just signal that he was in good company when he talked about the restructuring of the PYE bonds. And the reason is this: we need to create liquidity in the economy. When we ensure that we have more disposable income, then we stimulate economic growth. And this inevitably is also going to make George Orwell's work a little easier, because as the economy is growing, then we have more activities that are happening and more opportunities to tax the population. So my call is, let's go back to the medium-term revenue strategy. There are a lot of promises that were put in that medium-term revenue strategy that are yet to be actualized. One is actually revisiting or reviewing of the pay-as-you-earn graduated scale and make it fair so that people are not feeling overburdened by tax.
Commissioner.
Thank you. Let me start by saying this, and my chairman normally says that. He says that there's no state without taxes. I agree with that. No state without taxes. And it means, therefore, this discourse is a very good discourse. Because then when you're having this conversation, we are making it better, we are sharpening it up, we are getting convinced, we are convincing. Out of that, we get a very good model. And I will tell you that the things we're implementing, we have benchmarked also with other countries, which are doing very well. And we benchmark with other countries and seen what it is that they're doing, which is working well for them. And then we brought that home. So we are trying to just make sure that we get it in the best way possible for everyone. And obviously focusing on making sure the cost is lower, it's easier to comply, and do all these kind of things we are doing together. The discourse should continue. Thank you.
George, I'd like to ask, in your spirit of benchmarking, I don't know whether you've seen the latest changes in VAT in Tanzania. It's coming down, but it's a story for another day. Peter, please.
They're getting to where we are. You remember they were at 18%, yes. So they're getting to where we are, and we are seeking to go further down.
Thank you for that, Peter.
Yeah, thank you very much. I think in terms of closing, mine is to observe that the tax landscape has quite fundamentally changed, and that has significantly increased the tax obligations and compliance obligations. Many are international based in terms of local file, master file, country by country reporting, and so on and so forth. And today, we look at the tax teams in the industry. They have quite a lot to do, from pillar to post. And I think the best we could do for the industry, as compliant as the banking industry, really is when we come to participating and honoring our constitutional obligation on public participation. When you hear bankers, make noise or make suggestion about this or that proposal, I think given their level of contribution, it means that there is actually something that is either not good for customers or not good for the economy. In some instances, we've been quite successful in having conversations, but in some others, we have not, like the 5 days payment of withholding taxes. So I think we do look forward to better collaboration, but more than anything, when we see something is contra economy and customers, we raise our voice, and we only hope that it will be good to be indulged. Thank you very much.
Friends, thank you very much. Let's appreciate this panel for their insights. And I would like to usher you back to your seats. Asanteni sana for being part of this conversation.